Hi, everybody. Welcome to Kashmir Conversations. I'm Farbad Nozad. I'm the co founder and CEO of Kashmir.
And I'm Ishan, co-founder and CTO of Cashmere.
And today we're here with Jeff Reitman, general partner at Canapi Ventures. Jeff, it's great to have you here. Thanks so much for joining us.
Yeah, thanks for having me. Excited to be part of the inaugural episode of Conversations here.
Yes, awesome. Well, Jeff, maybe you can just tell us a little bit about yourself. How did you end up at Canopy? What was your journey through venture capital today?
Sure. I'm a walking case study that life is not linear. I tried to plan out my career when I was getting out of college and it just didn't work. So I started out as a CTO, co-founder of an online games company, founded the company back in 2007. Raised at a pretty epic time to raise, like what would be now called a pre-seed, and then ran the company during an epically terrible time to run the company, which was the global financial crisis. And I had no idea why things were melting down around me. I had zero financial education coming out of college, and I just knew it was really, really hard and really hard to raise. So we ended up selling that business in 2010. I did some soul searching and decided I wanted to go back to business school to learn more about the business side. Spent 2 years there and then did a bit of an odd move, which was go become an investment banker at JP Morgan. And that was actually the hardest sale today still that I've ever had to make. It's convincing a bunch of bankers that I wanted to go from being a founder to a banker. And they put me randomly in the financial institutions group. And so about 13 years ago, that was my foray into financial services. Um, in 2014, I got the lucky opportunity to partner with the former president of Visa, a guy named Hans Morris, who was starting NICA Partners, and helped him build that from the ground up for the first 5 years, and then left in late 2018, early 2019 to join my partners here at Canopy to help us kind of launch what we have today. Last decade in venture, it's been quite a wild ride, especially in fintech, but excited to keep doing it.
Yeah, that's awesome. I think really good journey. Gaming to fintech, not the natural bridge there, but I think when you kind of lay the story out, it makes perfect sense. And maybe you could tell us a little bit about what Canopy does. You've been there since the early days, and I think it has quite a unique value proposition.
Yeah, so we are an enterprise software and fintech venture capital fund. We invest in everything from seed to growth, so I have a pretty wide mandate. We have about a billion for under AUM across two different funds. Fund one is fully invested, which was 650 million. Fund two, we are investing out of right now, 750 million. And we really split our mandate where about half the team focuses on early stage seed Series A, select Series B, and the other half focuses on growth. And what makes us pretty different is that we're backed by over 70 financial institutions in the US. And what that does is it allows us to gain pretty clear insights into what the enterprise could benefit from. And it allows us to get really clear feedback from those different institutions on whether things may work for the financial enterprise or not. And so we try to leverage that for the benefit of our portfolio company and even to the extent we can for the pipeline companies that we're evaluating investment into. And the model has really worked for us over the last, half decade or so. And we hope that we can continue compounding that to generate best in class return.
Yeah, awesome. Maybe we can just dig into that a little bit. Like, what is kind of that framework you guys are using to assess, investment opportunities, especially given all those natural synergies that you have with the banks, with the financial institutions? I mean, is everything kind of placed in the context of how it could also benefit the LPs and vice versa? How you all might have a unique advantage in being able to serve a particular company?
Yeah, well, first, we really are clear with our LPs in the market that we have a two-pillar strategy. The first is to generate great financial return. The second and close second is to generate really awesome strategic value for our limited partners. And so we don't just invest in things that serve banks or can partner with banks. There's plenty of examples of things in the portfolio that serve the broader ecosystem and may one day partner with banks, but there's also a lot of things that do serve banks. And so it's not just one, it's definitely both. But we have invested heavily in a platform that engages deeply with our banking partners. And so we listen to them a lot, hear about what their roadmaps are, what their priority sets are, and then we cross that with our own experience. So I think across the GP, just about all the partners have had, in some cases, 40 plus years of financial service experience. In other cases, like me, almost 15. But it's a lot collectively. And so when you cross that experience with what you're hearing, you could be both practical and visionary in practically investing in things that would be bought today, but also backing things that may be needed in 5, 10 years from now, which is as much a part of the job in venture as anything. So when we meet folks like yourself and we're looking at Cashmere before we invest, right? It's easy to call in the wealth groups of some of the banks that we know well and say, hey, how are you thinking about growth? What are you investing in? What are the priorities? And it's pretty cool to hear time and time again. It's like, we need a solution for prospecting or data enrichment. And it's like, wow, that signal becomes really clear that we need to have a bet in space.
Totally. And I think this is something like Ishan and I have really felt working with you guys is there's so much specific knowledge, in this industry. And for us, we're basically completely new to financial services. And so having kind of that wisdom behind us has helped a lot, right? Ishan, I mean, the way we've been able to, I think, kind of navigate potential customers, technology, thinking about processes. You can learn those lessons on your own, the hard way. And it definitely slows you, naturally would slow you down, or it's just kind of how you go through that evolution. But having kind of a partner like Canapi has definitely made us, I think, a lot more effective in kind of be able to navigate that space.
Yeah, 100%. It makes me curious how typically you're looking at startups from the perspective of the banks. Have you guys also considered incubating any ideas? Have some of the LPs, the banks come to you and said, this is what we'd like to see. And then you go to founders and say, here's an idea. We can put you through some kind of process to get it there.
It's a great question, and it's something we talk about a lot. We've always had incubation as sort of like a thing on the roadmap of stuff that we need to really tackle at Canapi. Part of that is a real nod to my partners Chip and Neil from Live Oak. They incubated, Live Oak, and then they incubated Encino from within Live Oak and many other companies, Finxact and others. And so there's no one, I think, on the planet who knows how to incubate financial services tech as well as they do. And so I think we have the DNA to be able to do that. And there are cases where we are tinkering with early stage founders, or even Live Oak is incubating a company that they kind of spin out here or there and we'll get involved. And so we think about it as there's two types of incubation. It's like, one, you find an idea first and then you recruit a team into that idea. You're sort of half running the company while it's getting off the ground. And the second one is you find a really early stage team that can really, really benefit from getting in with you early. And then you help, I don't want to, maybe kingmake is the word, that company, and you help basically accelerate the lessons learned. And so like a good example of the second one is a company called ModernFi, where the team there is phenomenal. And it's not that we've incubated that company, but we did lead their Series A. Invested a material amount of capital for a good amount of ownership. And, my partner, Gene, he created the predecessor company of what Modern is trying to do, which is a reciprocal deposit network for banks and credit unions. And so we have immense knowledge and connectivity there. We know that there's a need, especially post, the SVB collapse and some of the stuff that happened early last year. So investing early stage and putting a ton of our resources behind making that company successful in some respects is the incubation that we tend to be able to execute more easily. And of course, we'll try to do the first type, but it's a definite harder lift, especially when we're a thin team and, very focused on just the investing part of the job.
Isha, I love that question. It makes me think, on a broader scale, Jeff, are there opportunities within financial services that you think are available today or that you're kind of really excited about? Maybe, I think the ModernFi example is a great one. Other companies you've seen, or maybe opportunities that don't have a company behind them, just yet?
Yeah. Well, on the second one, I try to actually, so over the years, like in lessons learned, I've tried to keep a lid on my visionary ability to predict the future, because the reality is like, it's the founders out there that tell the future. It's the VCs that find the founders. If you try to do it the other way, it gets all messed up. You start to be drawn to your own ideas versus being drawn to the best people. And so like, I find that to be a little bit dangerous. But the short answer is like, I'm drawn to anything that's pretty boring, actually. It's like part of it is like I have learned a lot about financial services over the last, 13 years. And I can appreciate some of the nuances, especially as it relates to what sells into the enterprise. And so people wake up and might say, hey, like model risk management, like I'm not interested in that. Or, loan management systems, like no way would I touch that. And I think actually getting into the nitty gritty and understanding like where the value is in those pieces and what they enable, that's super fun. And then it's all about finding the right founders that bring those ideas to the table. And it just so happened we invested in a company called Ethos this year that does model risk management for banking. Yeah. And that's going to enable the adoption of AI. And so everyone out there could be investing in some of these shiny AI tools that might take a long time to sell into the enterprise. We're going to spend time doing that as well, but also spending time, investing in some of the core infrastructure that we know is going to be needed to adopt those tools. And so that's, a pretty big thing about what excites me. And hopefully I'll meet some founders in 25 that kind of bring the same level of energy to that.
Yeah. Especially in the age of AI, these non-shiny ideas are so important. And a lot of people are lost in what could be seen as the hype. And maybe it's not hype. It's hard to really tell. But during my time when I was at Goldman Sachs for a few years, I also saw how important something like model risk management was, but no one talked about it, right? My team back then was a machine learning team, but still model risk management was two people we worked with compared to, a much larger organization. And it was so critical as a gateway to everything we did. So just to say, 100% I can see that.
Yeah, look, we're huge believers in AI. We're going to be investing heavily in the space. I think it's going to change the way the industry works. But there's a lot of, debate, especially even within myself on, the legacy vertical SaaS businesses going to just inject AI into their offerings and then offer better products to the banks, or are they going to be the new companies that come up? And it's not so obvious, right? Distribution here is really valuable. And so I think some of the enablers, though, that is kind of obvious to me that's going to be needed and required. And so it's like anything that's super boring, sleepy, I'm pretty, but also with a great team and a good market, I'm pretty drawn to it.
Yeah, and I think this kind of also goes back a little bit to, the advantage that Canapi has, like that specific knowledge. You guys understand what those opportunities are in a way that I think probably like a generalist might not necessarily be privy to because they're not spending so much time, with these institutions and understanding kind of where the gaps are and what they need. So I think that's pretty cool. And, we made it pretty far without saying AI, but I think now the cat's out of the bag. And Ethos is actually like a really great, I think, bridge to this, right? Because the idea is how we can kind of enable, new technologies inside of kind of a lot of these legacy institutions over the next, decade or whatever. I'm curious, Jeff, everyone is kind of talking about how AI will impact financial services. I mean, there's a dozen and one ways that it's going to come into life. I'm really curious if you have any thoughts on, again, how you think it's going to have the biggest impact. Where do you kind of see financial services evolving over the next even 5 years, just because this stuff is, I think, moving at such a fast pace?
Yeah, I think it's real. I think the way that it evolves within financial services may be a little bit slower than the way it evolves outside of financial services. A lot of that is just because of the regulatory environment that financial services companies have to adhere to. I think you're going to start by seeing a lot of internal use cases where people try to automate internal workflows, internal knowledge management. We have a portfolio company called Posh that does internal chatbot and knowledge management systems for financial services companies and credit unions. And so I think we're going to see a lot more of that because when it doesn't have to touch the customer, there's a little bit of less scrutiny in terms of how it's applied. You could also fine tune things and make sure that it's compliant. And there are tools that are coming out, to help with that as well. And so I think it's going to start there. AI is really, really useful actually at taking unstructured data and summarizing it, or taking unstructured data and allowing it to be somewhat structured to then go and make automated decisions on. And if you think about like interesting examples of unstructured data in financial services, like tax returns, audited financial statements, like partially structured, partially unstructured. These are things that people have to review continuously for mortgage underwriting, for commercial loan underwriting. I think there are going to be tools. There are already some tools that were doing this using OCR, and then some, kind of, I'd say, human in the loop intervention. But I think we're going to go to fully automated in the way we could use that. And so you should be able to see a lot of growth enabled on the bank lending side based on some of these AI tools. And the question is, again, like, are there going to be new companies that come out and do some of this? I think the answer is yes, and I think they're going to be AI natively built, and I think they're going to be able to move really fast in how they code. But I wouldn't discount a lot of now they're still startups, but they're almost like legacy in the way that they're
Yeah.
built, where they might have 100 or 200 banking customers, and they're going to inject a bunch of automation into their product to make their product just better for the folks that bought them, right? And I think we're going to see both in time. And so I think AI is going to revolutionize the whole industry, but I think it will take a little bit more time than folks think. Just like the driverless car thing, it's like it always takes a little bit longer to like fully automate in a compliant way. But once we cross that chasm, I think it's going to move quickly from there.
Mhm.
Yeah, I think that's something that resonates, I think, with us as well. I mean, we've seen in the wealth management space the adoption of those internal tools happen pretty quickly. For example, AI note taking is a really kind of hot topic in the wealth management space. And, again, to your point, Jeff, like it doesn't touch it's not directly customer facing, it creates efficiencies. And I think why the adoption can happen so easily is because it's very straightforward on how you kind of measure ROI, right? Time saved, you can really feel kind of the efficiency gains by the advisors. And so it's really easy to kind of create a narrative and a story around the value that a product like that creates versus I think with some of the other technology just has a longer kind of like cycle to prove the actual value of the technology itself. And so, thinking, as we think about even, for our own business, like how can we kind of shorten that whole process for how quickly we can prove ROI and kind of the value of using Cashmere as institutions kind of bring it in.
I mean, when we met, one of the things I really appreciated actually was you didn't show up and say, "Hey, we're an AI company that's going to like basically use generative AI to generate prospecting leads and enrich data and whatnot." But you kind of took a step back and said, "Hey, there are really strategic places we can leverage AI to do things faster and more accurately, which then service higher quality products that are going to benefit our customers." And so just like thinking through, hey, there's a lot of data that we access that we try to find signal in, leveraging AI to comb through and cleanse that data is a really, really great application for the technology without necessarily making it all about AI, right? And so I think in time, I'd imagine a lot more of our product becomes AI native and driven by different innovations that kind of emerge over the next several years. But right now, we're sort of efficiently applying that, and I've always appreciated that. I think like I'm drawn to that aspect of a lot of companies I'm seeing in the market, just because I know how long it takes to build a good product and to get things distributed. And so you need to kind of focus on both the product and the AI pieces.
Yeah, in many ways, I consider we as Cashmere got lucky, right? They say that new technology is built in the back of waves. And as we discovered the problem in the wealth management space, in the financial space, we also at the same time had these new tools emerging with the AI where we could not only take our previous skill set and solve these problems, but also use the evolving, continuously improving toolkit that's currently available to tackle these problems in real time and show that to potential customers that, hey, we can use these tools that may not be understood by a lot of people yet and really try to solve problems that would have taken a much larger team or a larger cycle, even just 6 months back.
Yeah, I think it'll open the aperture of what data sources we could use in time to predict other things, right? Like the imagination we could have in time, I think will grow pretty large as we get bigger, just because we're going to be able to ingest and interpret a lot of things that otherwise wouldn't have been as easily interpretable, and that data will provide access to potential other insights that we could leverage for our benefit and for our customers' benefit. So I think that's going to happen in our favor, and it's a good time to be innovating in space for sure.
Yeah, yeah. So I think that's a really interesting point because like another way we've thought about it is previously when you create software, I think you have these kind of like subconscious limitations you put on what is and is not possible. And now we kind of take a step back and think, okay, what are all of the processes that we do as human beings like naturally? Let's say in the context of data, it's often some sort of like research or it's trying to generate some sort of signal from larger bodies of text. And we don't realize that humans are really good at naturally identifying patterns that otherwise would be extremely difficult to try to codify, right, or build kind of deterministically into code. But when you start like kind of recognizing all those small like intuitions that you have when you look at data, you can kind of start breaking it down and translating it into, now with LLMs, like into a real system, something that's kind of automated. And that's kind of the perspective like we take on a lot of product building. And I think to Ishan's point, he always says like AI is it's just another tool, right? It's another tool in your toolbox, the same way databases are, or taking advantage of cloud, or even traditional machine learning. So I think we're excited about it. I think there's gonna be a lot of new ideas that people just haven't thought of yet. It'll require, I think, some behavioral changes to happen, maybe on a more macro level, in order to create those opportunities. But yeah, we're really excited. Maybe to switch.
It'll be fun to watch.
It'll be fun to watch. I mean, you have a great seat for it. You get to see like all the stuff kind of across the landscape. Where we kind of have tunnel vision a little bit. We're just focused on what we're doing mostly and get glimpses here and there.
You got to stay focused. I'm a big fan of focus. Keep going.
Jeff, maybe to talk about like a little bit of the industry. We're in wealth management has been a really, I think, hot topic this past year. I think wealth tech specifically is getting a lot of attention. You've probably seen that from the VC side. And I think even as we speak with a lot of financial institutions, historically, obviously doing traditional banking, I think wealth has become kind of a larger, just a hotter idea for them from a business standpoint. I'm curious, are there any ideas or just, opportunities in wealth management that are exciting you today?
Yeah. I think it's one of the most exciting categories. It's where I'm spending probably the most of my time. And, before I get into your exact question, I'd sort of say two things. One, I've been looking at this space for the last decade. And 5, 10 years ago, I didn't even want to touch it with a 60,000-foot pole. It was just like you either sell to banks or you sell to RIAs. Neither were amazing buyers of wealth technology software. You had a few big incumbents that built really big companies, but over 20, 30 years, like the accelerative factors just like weren't really present. And technology, I would say adoption within the industry was not great. You had advisors that wanted to do what they wanted to do. They weren't really looking for tools. Everything was a little bit more of the old school way. And that's changed a lot. I think the openness to adopt technology now with the new crop of advisors that are coming in, a younger crop, realizing that you need to offer best-in-class service to your customer because you need to have some reason outside of just pure relationship that they would go with you as an advisor or as a banking platform. The second thing is, as rates rose really fast over the last couple of years, bank NIMs compressed a bit. It became clear that you needed to pay a bit more for your deposits to retain them. And so your profitability went down. And so there was just a natural, idea that we had here at Canapi to go after what would be fee-based businesses that banks would want to invest in. And so payments is one, but wealth is the big other. And I think we're seeing the fruit of that now at Cashmere, right? There's a ton of banks out there that want to talk about how they can grow their wealth business leveraging our tech. And I think a lot of it is based on those historical patterns of why they're interested in this. And so those two things together led us to dig pretty deeply into wealth. And in doing so, I realized it's one of the best business models of all time. It's like SaaS Plus, because you get recurring AUM fees that grow, whatever it is, 7 to 10% with the market every year. So that's great NDR from the SaaS perspective. And, everyone talks about fee compression and maybe we'll see some of it, but the fees are pretty healthy in the space. And so that means that advisors can go now and invest that profitability into tech, into AI, co-pilots, things like that, right? And I think all of that is coming. And so I think what started as, hey, robo-advisor is going to be the tech thing. Now you have full scale platforms, on helping people run their businesses, helping people find a home if they want to leave their advisor and go kind of hang up a shingle and grow their book. You know, banks are constantly looking to figure out what retail customers are going to be wealth customers. I think we could really help with that. And so, you know, just even retirement, there's a ton of really interesting things in the retirement space. Again, a sleeping area not a lot of people talk about, but you know, we invested in Capitalize, which automates 401k rollover, and hopefully will rebuild some of the piping of wealth over time. So I think there's a lot of amazing innovation. We're constantly seeing new things pop up, and so I'm really excited for the next decade of wealth tech.
Amazing. This is just out of curiosity, given your decade plus in the industry. Have there been any regulatory changes or things that could have been additional tailwinds? Because there's environmental factors, macro factors, there's technological factors, but post financial crisis, regulation has gotten so much stricter, particularly for banks. So I'm just curious if anything has changed behind the scenes that actually might be an unlock, or has it just purely been kind of the environmental factors at play?
There have been regulatory changes. I need to think about it, how that might unlock the innovation. I mean, some of it was like there was a DOL, Department of Labor ruling around fiduciary, basically saying that, hey, like advisors actually have fiduciary over the assets that they're investing on, and they need to make sure that they're investing in things that are transparent from a fee perspective, that they're creating an environment that's safe and in the best interest of their customer, not one that's just going to pay them the most. And so you've seen a lot of technologies sort of pop up to expose like what fees are being paid for what. There's been a lot of, I'd say, positive move to passive like ETFs with low fees, like away from some of the higher fee mutual fund products that have been out there. And so I think that's one regulatory change that I've seen take place. I think there's been some technology that has been adopted on the fringe of that. I think whenever there's like a responsibility that's added to the advisor, usually that comes with their need to purchase some technology or vendor to help support in the right ways. So I think that's probably on the regulatory front, but I think there's like bigger macro changes are just around aging out of advisors, the massive wealth transfer that's going to happen between the baby boomers into the millennials and Gen Z. And so that's going to create a big impetus to go out and say, hey, how can I grab hold of these assets? How can I retain these customers? And so people are going to need tools for that. And they're going to look very different, I think, than the tools that they've used in the past.
Yeah, that's great. Like if I'm the CIO of a bank or if I'm the CEO of an RIA, Jeff, like how should I be thinking about adopting new technology? Like what can I do to be kind of a better steward of all these, new startups, of all kind of like these macro changes that are occurring?
Yeah, I mean, I think the first thing is just know that you need to be doing that, right? And I think adopting new technology is kind of a necessary thing today, where it was sort of optional probably 5 or 10 years ago. It's sort of like you need to be on the front end of innovation, and the way to do that is to partner with best-in-class innovators. And I think I've seen that movie play out a few times now, and I'm a pretty big believer in it. On the flip side, those executives are constantly focused on so many things, right? There's been a very intense regulatory environment over the last 4 years. Regulators have been on site at a lot of these institutions, really kind of data requests, processing, oversight, everything. And then there's businesses to run, right? Making sure the business is capitalized properly, all of that stuff. And so in light of that, focus is really important. And in light of that, I think getting to an answer fast is the best way to innovate fast, right? Just like finding, innovations that you like and saying, hey, yeah, we're going to, in, 90 to 180 days, say, yeah, we're going to test this thing. And this is clearly how we're going to do it. And if we achieve the right result, we're going to buy it, and we're going to buy it for this price and how long and all that, and being really prescriptive with that. And conversely, if you're not going to get there, saying no fast is the best way to preserve, an institution's reputation in the market. And so I'd say there are a lot of banks and a lot of enterprises in general that get that right. And then there's a lot that get that wrong, right? It's the 12 months to a no. It's the, almost a yes, but then kind of back into a 6-month cycle to get to a no. Those are areas where that just curbs innovation, right? Because the word gets out on those places, and it's just harder for innovative companies to want to go and sell to those institutions. And so I think it's both knowing you need to innovate, focus, and just getting to a yes or no pretty quickly, and maybe even just with a small handful of players, right? And it doesn't have to be 100 new things a year because that's unreasonable. But those are some of the key learnings that I've kind of picked up over the years and best practices on what we talk about with our LPs.
Yeah. And I've seen, some of those differences in culture too. There are some massive banks that really have leaned into an innovation culture, and despite their size, they're able to be quite nimble in terms of working with startups, having effective processes, and you see kind of the fruits of their labor. Like they've adopted a bunch of technology and they've created a really excellent experience for their clients, for their advisors, for their internal operations. And we've seen the flip side of that. Institutions that are orders of magnitude smaller, but they don't have that culture. And, you'll get stuck in compliance for 8 months or legal review for 8 months, and they just can't get the ball moving down the field. So a lot of it feels like maybe it just starts with the people too, right? Inside of those institutions and kind of how they think about these opportunities.
For sure. And I think that's changed a lot over the years in a positive way. I think teams really understand, like I said, that they need to innovate as a number one or number two most important thing to do. It used to be like probably about 7, 8 years ago, there would be institutions that would only partner with startups that they had 3 years of audited financials, but the average startup they were looking at only existed for 2 years. So then you just know that there's going to be no partnerships, right? So it's like you can't even, where do you start, right? When it's like that. So, a lot of the early days of my venture career in between financial institutions and startups was just educating the institutions on why they should compromise on some of their strict requirements in order to get the best of in the market. And I've seen that move so much to the positive over the years. And I think it's going to continue moving in that direction just because there's just been an explosion of amazing technologies out there.
Yeah, it's like the leaders of these financial institutions have to think like founders. They have to innovate, make a lot of decisions, be wrong on some of them, where it's tougher to be wrong, again, given regulation, given compliance. But these seem like the risks that you have to take, especially coming out of the past 5 years, which has been a very quickly evolving macroeconomic landscape. The ones that are surviving and thriving are the ones that are making the most decisions the fastest and quote unquote failing fast when they need to.
Yeah, and that reminds me, it's like there will be some institutions out there that are the leaders always, like they're happy to contract with a company with no referenceability in the market because they have a good testing environment, or it may be that they're really big, or it may be that they're really small and that there's more, centralized control. And then there are fast followers, and then there are laggards. And I think just like owning where you are, or at least deciding where you want to be and acting accordingly, is really important. Right. And it's okay if you're a laggard and you are, that's great. That means that you just have to wait till companies have maybe 5 or 10 referenceable customers before you pair up. But if you're prescriptive about that with those companies, it saves a lot of time. A lot of dollars, venture dollars get saved, and not selling through super, super long sales cycles.
Awesome. Jeff, we've known each other now for, I don't want to say a year and a half.
Over a year.
Over a year.
You and Harry a little longer, but
yeah. And officially been working with each other for, I think, a little bit over maybe 6-7 months now, something like that.
Yeah.
I'm curious, why did you guys invest in Cashmere?
So I don't want to flatter you too much on your own podcast, but I think, look, it starts with the team. At early stage investing, I think the team is like 90%. And I remember meeting you far out in LA and just, grabbing a cocktail and hearing about your journey, starting a blockchain-based podcast, audio-based company and finding your way into wealth. And I remember leaving that time and just saying, wow, like you have an energetic entrepreneur who's a clear communicator, who has real obvious grit. And then I met Ish, and you guys have known each other since high school, and you have a right to innovate, and you were able to get him to leave his fancy job to come and dive into the deep end with you. And I think there's just tremendous value behind that. And it's sort of like, the purest VC in me would say it didn't matter what you guys were working on. I just wanted to be a part of it, right? I think the more practical side of me was like, okay, well now I knew what you were working on, like how did it evolve? And when we met, we weren't even really investing in seed at Canopy, and I thought this was sort of a build a relationship with you guys for the Series A, and that evolved to the positive. We started investing in seed earlier this year, and I got to watch your journey of like, hey, we're through this pivot. We think there's a market here. We're testing it with one or two, but when we really started spending time, that one or two became 10. And I was like, wow, okay, there's something here. And then we did some market work, and it turned out everyone really cares about growth, and everyone really cares about growing, whether it's, cold outbound or referral, or whether it's inorganic. And it just like the clarity with which you guys are able to think about building cool products in the space was just inspiring. And so then it became obvious we needed to work together. And then it was just about finding, a way to do that. And I'd say even over the last 6, 7 months, it's like our product's gotten 10x better. And like that's cool. I think that's a function of that energy and just, the trust you guys have for one another, seeing that come to fruition. And so I feel really, really awesome about our decision. So it's been a fun ride, and I'm looking forward to hopefully the next decade of continuing.
It's been a great ride. I remember coming out of that first meeting we had, I called Ishan immediately. I was like, Jeff poked so many holes in our business. I was like, but we have to work with him. It was good. It was a lot of fun. Yeah, and I agree. I think the evolution, like the last, 6 months even, right, of like how I think the product and the vision has continued to grow has been really exciting.
It's been fun. We got a lot to do though.
Cool. I think we'd love to leave you with one last question. And then I don't know, Ish, if there's anything else you want to talk about. But I'm curious, Jeff, from your own personal perspective, what has been the most important lesson you've learned as an investor this past year?
So I'll kind of give two things. One, which is not really a lesson, but I just love seed investing actually. It's like just doing it. I invested in 3 early stage seed companies this year, and it just reminded me like how much fun it is like working, almost at like day zero with energetic teams. It's just like the possibilities are endless, and it's just so energetic and fun, and I love it. The second thing, the lesson is just like how valuable conviction in people and founders are, and not losing that over time. I think founders, I was on the other side of the table and start my career, but they just want people to believe in them. Like the rest of the stuff is like, hard. It's going to be hard. There's a lot of ups and downs. Patience is important, but like what comes at a premium is just like unadulterated belief. And I think I've been through it with some founders this year. It was tough markets last year, and it's just like really fun to show up for them and how important that is, and watching them rally through that. And so that's been just like kind of a renewed lesson. I always sort of knew that, but as I play, more important role around the board with some of these companies, it's just really fun to kind of be there for those founders and just really kind of see their journeys through to whatever the end state may be. And so it's been a year. I'm excited for 2025. I think things are going to open up a lot in the market, but yeah, it's been a journey this year.
I love that. Awesome. Awesome. Well, Jeff, thank you so much for coming on to this, for having this conversation. I think we had a lot of fun.
Yeah, thanks for having me. I love hanging out with you guys, and I hopefully this will be a good kickoff to a long running podcast that you guys have.
Yeah. Yeah.
Awesome.
Awesome. Awesome.
All
Well,
right.
great. Well, this was episode 1 of Cashmere Conversations with Jeff Reitman. Thank so much.
Thank you,
Thank you.
Jeff.
See ya.
Thanks, guys.